This week, Learning Saturday, we have 3 exciting webinars lined up for you. At 10 a.m., we have the new fixed income playbook, strategies for a falling interest rate cycle. At 11 a.m., we have Zero to Investor, how to start investing from our very first salary. And finally, we have Anchor Awaits, India's port and logistics sector. To join this webinar, kindly click the registration link in the description.
Hi, welcome back to another video for Ithought Connect. And in today's video, we'll discuss some of the portfolio risks that you must know as an investor and how you can maybe handle them. Of course, investing is on the rise across India, and each new participant in the market is a testament to the growing financial awareness. But while enthusiasm is at an all-time high, risk never takes a break. Whether you have a diversified investment portfolio or a highly focused and concentrated one, unforeseen risks like an abrupt market downturn or valuation corrections and global shocks can silently eat into your wealth and threaten your goals if they're not managed sensibly. So some of the common risks that we see are market and valuation risk, right? It's especially very relevant now. The Indian equity markets hit record highs and has also seen surging domestic flows and optimism. However, certain pockets of the market, especially among the small and mid-cap stocks, have become expensive. Now, these high valuations, it leaves portfolios exposed. One earning shock or global event can trigger swift corrections, particularly in momentum-fueled or thematic strategies. And the right way to address this might be by tying your equity allocation directly to your financial plan and not to today's index levels. So prefer companies with a demonstrated record of earnings growth over those driven purely by sentiment. And you may also want to use staggered investing like SIPs to spread entry point risk and focus on your long-term plan. But given where the equity markets are now, it's also a good time to add your lump sums. Another significant challenge is concentration risk, and this is something that we see in a lot of portfolios today. Of course, many portfolios are built around narrow set of themes or sectors, a stance that naturally rotates over multiple market cycles. While a skilled fund manager or a portfolio manager may aggressively back a theme, too much concentration can leave you exposed to sharp losses when markets turn or sectors fall out of favor. And mitigation starts by setting explicit limits on individual stock, sector, and market cap exposures. Small cap stocks should enhance, not define your portfolio. Choose diversified mutual funds or PMS products where the manager actively manages exposure, thus guarding your capital through disciplined sizing and liquidity monitoring. But perhaps the most underestimated risks are behavioral and timing risks. Frequently, what hurts a portfolio most isn't the market, but the investor's response to its moves. And I'm sure we've all been there. Jumping into past winners or selling out of valuable but temporarily underperforming holdings or trying to time markets around macro headlines. All these behaviors can destroy far more wealth than any external shock. And the solution? Establish and stick to rebalancing rules. These could be set by time, like a semi-annual review, or by threshold, realigning only after a meaningful drift. And judge strategies over entire cycles, not knee-jerk snapshots, right? Stick to proven metrics like drawdowns or risk-adjusted returns, not just short-term gains. And crucially, work with a trusted advisor or a disciplined PMS team who can bring process, rigor, and objectivity to your investment journey. So in a market as vibrant and unpredictable as India's, or any country for that matter, risks aren't a reason to stand aside. They're a reason to invest with more clarity. India's corporate fundamentals are solid at the moment and the policy environment is looking supportive. But these strengths matter only if your portfolio is structured to weather that turbulence. Building true investment resilience means right-sizing risks, diversifying intelligently, and always aligning your money with your real goals and time frame. Now that's where the catch is. A strong portfolio doesn't magically make risks disappear. It transforms risk into an ally that works for you over time. And knowing your biggest vulnerabilities, whether in valuations, concentration, or your own impulses for that matter, it puts you firmly in the driver's seat. You stop reacting to markets and start shaping your outcomes for the long run. If you want discipline and structure but don't want to watch the market every day, consider a solution like Ithought PMS. Here we have a team that builds and maintains portfolios with clear risk budgets, defined drawdown thresholds, and a thoughtful spread across sectors and asset classes. With regular reviews and transparent philosophy and mapping every goal of yours to an investment, you gain that clarity and comfort that you need to stay invested letting compounding do all the heavy lifting. Think hard about risk, then think just as hard about who's guiding you through it. Don't forget to reach out to Ithought PMS to review your current portfolio, find hidden vulnerabilities, and realign with what truly matters, your goals and your time horizon. Build not just for India's growth, but for resilience to help you stay calm, stay invested, and make your time your greatest ally.